Good morning. I have two challenges today. One, I am following Shankar and Naren, so that's a challenge. The second challenge is I have taken a very difficult topic to talk about today, and that too in about 25 minutes. Let's start off immediately. What is a trend? Not just in the market. Trends are everywhere, right? In fashion also. A trend is an idea that spreads. It has more and more adoption. That's a trend. I'm going to talk about the trends in the market using ideas from a historian, a psychologist, a celebrated hedge fund manager, and three behavioral economists. Two of them are Nobel Prize winning economists, and all in this short time. So let's start. It's tough because I'm going to start about 100,000 years back. 100,000 years ago, human beings were just another species in the world, and not the most strongest or the smartest species in the world. We were similar to a chimpanzee, but less agile. We were definitely not stronger than lions and tigers. Then how come this species started ruling the world in just a matter of 100,000 years? Human beings have one unique quality that other animals don't have. They can work together in large numbers, working with even strangers for a common object. And how do they come together? Because of creativity. Human beings can create narratives and stories for everyone to come together and work towards a common goal. Let's take an example. If a lion passes by, other animals know that's something to be scared of, run away, or some animals may want to attack. Human beings are the only species who can say that let's come together, there is a lion spirit up in the sky, and that spirit will take care of us if we all peacefully live together and work together. This is a picture of a relic, a large one found in Staddle Caves. And the carbon date for this relic is about 35,000 years back. This relic has a body of a human and a head of a lion. This is the first and the earliest evidence we have of figurative thinking of human beings. Human beings can create fictional realities and work together. That's how we come together with common beliefs, values, laws, religion, right? Yuval Noah Harari, in his book Sapiens, says the secret sauce for human beings was narratives. And narratives made us cooperate together in large numbers flexibly. Economics is the queen of social sciences. Somehow, economics and finance connected to that never adopted this tendency of human beings to create narratives and work together. Every other social science accepts it. Psychology, sociology, everyone accepts it. But economics doesn't. Thankfully, Robert Shiller, a few years back, came out with a nice book on narrative economics, and where he actually defines how human beings, through narratives and stories, can actually impact economic events and obviously the stock markets. So we need to understand how people create here. Robert Shiller gives an example of recessions. This is how a recession is created. What leads to a recession? The fear or the idea of a recession leads to a recession. If people are worried about recessions, they spend less. Companies postpone their capex plans. They save for a tough future. And because of that, people cause a recession. The fear of a recession causes a recession. What's the value of a Bitcoin? I don't think there is a fundamental value of a Bitcoin. It's a narrative. It's a currency of the future. It's scarce. And Central banks cannot control this feature. That's Bitcoin. Think about all the bubbles we've had in the stock markets. Tech bubble, infra bubble, PSUs. Valuations in different themes are driven by narratives, driven by stories, and that's what excites people, right? The second part is herding. People love to herd together. Suppose you are out on a vacation in a foreign country, you do city sightseeing in the morning, and in the evening, you have to plan dinner. You go to a nice street where there are many restaurants. You come across two restaurants. Both have same cuisine, similar prices. One of them is empty. The other is relatively busy. Which one do you choose? Most of the people do that. Most of the people will choose the busy one because if it has so much crowd, they can't be wrong. We feel comfortable in the warmth of the crowd. We believe that if the crowd has chosen it, it should be right. And many a times it works. But it becomes a tendency, then it's a problem. Solomon Asch, a psychologist, did a fantastic experiment. He got certain subjects and put them in groups of 8 people in each batch. And these people were asked certain simple questions. Now, Solomon Asch, smartly, he put 7 of his own confederates in that test, 7 of his own people. Only one was the real test subject. Now, questions were something like this. In the first card, there is a line, and in the second, there are 3 lines. You have to choose which line, A, B, or C, is similar to the line in the first card. Now, those 7 people were told that in certain questions, you have to deliberately give the wrong answer. So everybody gives the wrong answer, and then they ask the last person, what do you think? 75% of the time, the test subject went along with the crowd at least once in one of the wrong answers. 30% of the time, 30% of the subjects went with the wrong answer all the time. When they were privately asked later that, did you really think this was the answer? The person said, no, but I went with the crowd. Now, another very interesting aspect of this experiment. When the size of the group was increased, the conformity increased. More people. Second, if the questions were a little difficult, the task was a little difficult, people went with the crowd more. And if they were introduced, in your group, there are certain elite people, there are certain researchers, scientists, and all that, the guy went with the group. Now, in stock markets, all 3 conditions are there. There's a huge group, and media keeps talking about narratives all the time, loudly. There's a group of experts who come on TV and recommend to you every day, and sometimes even in here. Third, intrinsic value of businesses. It's a very tough question. So people tend to herd together. Okay? Now, what does herding do? Narratives create herding. Herding breaks the diversity of views, diversity of thought. And for markets to be efficient, people should have different views trading each other. But herding creates a biased view of the market. It doesn't lead to a zero sum. It leads to a biased view. So markets are not always right. Markets are always biased. Positive biases will have a positive impact on stock prices, which means the stock prices start moving up. As stock prices start moving up, it will lead to confirmation bias and more people will come and buy. So it's a virtual loop and what is called reflexivity. George Soros, in his book in 1987, Alchemy of Finance, talks about how perceptions, that is biases, stock prices, and company fundamentals impact each other. Now you will think, how come company fundamentals come into this? Think of a non-banking finance company, NBFC. The stock price of that NBFC has gone up. Valuations are high. Now this company can dilute a little bit of equity and raise a lot of money. The reserves go up. Now with the reserves going up, the credit analyst in a credit rating agency will say, okay, this is a fantastic company because it has huge reserves. Let me give it a good rating. The cost of borrowing for that company comes down because the rating is upgraded. With the rating upgraded, new and good depositors come in. or investors come into the company. Now, the cost of fund, cost of equity is low for this company. To make 4-5% margin, the company will not have to take huge risk, not go to the worst kind of borrower. So the asset quality is better, and this leads to a virtuous cycle. It also can lead to a vicious cycle the other way when the stock price crash. By the way, in credit rating agency reports of NBFCs, a fall in the stock price of an NBFC is considered to be a sharp negative event. You can check that out. So, let me come to another 2 studies which have been done on a stock universe. In the short term, there is a momentum effect as herding comes in. Herding comes in slowly. A study was done by Jagdish and Titman in 1993. They went with the theory that short-term winners will remain winners, short-term losers will remain losers. They tested it out. What is short-term? They said we'll take 3-month winners and 3-month losers and create a winner and a loser portfolio and hold it for 3 months. They found that consistently the 3-month winners outperformed the 3-month losers. Then they expanded the study to 6 months, 9 months, 12 months, which means they took 6 months winners, losers, 9-month winners and losers, 12-month winners and losers, and they expanded the holding period also. 3 months, 6 months, 9 months, and 12 months. 16 studies. In every box, winners outperformed losers in the short term. Now, why does that happen? This study is important, but it's not in any of the economic textbook or finance textbooks. Because academic finance doesn't have an answer for it. The answer lies in behavioral finance. People have a conservatism bias. Think of a small cap company which suddenly came with good results in a quarter. Most of the people say, let me watch this. If the next 2-3 quarters are good, I'll buy. Some people who buy will say, okay, let me allocate 0.5%, 1% to this company. If it continues that trend, I'll buy more. As the company starts doing well, more and more buyers are coming in, more and more allocations are happening, and that creates a momentum effect. There are 2 more theories on why momentum works, but let's park it here for now. Okay, in the long run, the reversal works. This is a study done in 1986 by Nobel Prize winner Richard Thaler and his student DeBont. They did something slightly different from Jagdish and Titman. They took 3-year winners and losers. So they created a portfolio of 3-year winners and 3-year losers. Companies that have outperformed for 3 years, companies that have underperformed for 3 years. And the holding period they kept for the portfolios was 3 years. They repeated the same test with 5 years and 5 years. They found that the losers consistently outperformed the winners this time. So in the longer run, stock price is reversed. Again, what is the reason behind that? People overreact to good news. Once a stock is doing very well for 3-5 years, everybody wants to buy it, everybody's talking about it, narratives get built up, high valuations are justified. High valuation means high expectations. They become glamour stocks. The moment there is a slight negative, they fall, they collapse. The opposite happens for losers. Nobody wants to track them, valuations are very low. Nobody talks on the media also. Sonia Shenoy, Lata Venkatesh don't talk about it, so half of the people anyway don't look at it. And they become vulnerable to any positive news that comes, and the stock prices jump moment there is a small positive. Now, the difficult task. Let's take narratives, herding, reflexivity, short-term momentum, long-term reversal, and see if we can create the market cycle. There is one line here which is the earnings per share of a company. Let's take it as a hypothetical value of a company. It moves on earnings per share. And then there is a stock price chart. The difference between them will be the expectations. Let's start with a prevailing bias, which is negative, that people are a little negative, nobody wants to buy. But companies have started showing better earnings growth that comes in. Some people start getting interested. There is some kind of buying that comes in because the results are good. Some people take notice of it. As the stock price starts moving up, more and more people get attention, get into this stock. There is a herding that is building up. There can be a correction in between, like between C and D. Some people may have disbelief and wait for some time. So it takes a pause, it takes a correction. But then, because the underlying trend is continuing, more and more buyers are coming in, it builds momentum upward. And that starts having a positive impact on the stock price, positive impact on the sentiment. Narratives get created that this is the stock to buy, right? No matter what valuation. Oh, you think it has gone from 15 to 30 times? It should go to 60 times. And it starts moving up. At some point of time, valuations and expectations become so high that reality cannot satisfy the expectations. And then when the trend starts flattening out, reversal starts taking place. It's become too expensive, numbers start getting downgraded, people are not happy with it, start selling. The first set of people, smart money, starts getting out, and then it starts a downward momentum effect of the reversal cycle in narratives and in herding. People start getting out. And then you see a sharp fall coming in the price. Here, you will notice, first, when market is moving up, excesses are created on the way up. And then the excesses are created on the way down. It doesn't stop at fair value. It will create a downward pressure. Think about some of the private banks, right? They're looking so cheap. Nobody's buying because they have corrected excessively. Why is it important to understand this cycle of the market? Because in every asset, in every period of time, the same cycle keeps repeating. And if you don't get this cycle, you will not have an edge in creating wealth for your investors. So it is important, whether you're a value investor, a momentum investor, a fundamental investor, it is important to understand this behavioral cycle of the market, because that gives you an edge, helps you create better wealth for yourself. At Bajaj Finserv AMC, by studying these market behaviors, and we go through many different behavioral tools in our decision-making process, we've created certain funds which are innovative and which helps the investors over a longer term. In the FlexiCap, we came out with a mega trends investment strategy. Mega trends are long-term trends that impact businesses, economies, and companies. So we use them to predict which will be the long-term winners and losers. By the way, this is exactly opposite of what the index does. What does the index do? Index always looks backward when looking at businesses and stocks. Infosys came into the index somewhere around year 2000. A lot of infra property companies came into the index in 2007, right? Many of these companies left the index in 2011 after 3.5, 4 years of a lot of pain. So index looks backward in terms of deciding winners and losers. Mega trends looks forward. We use the understanding of the behavior and how markets express their sentiment in creating a behavioral index for our balanced advantage fund. So we not only use fundamentals, we also use psychology. We use behavioral finance to create an asset allocation in the right way. In the recent fund that we launched in the equities, we launched it on moat investing, the large and mid-cap fund. See, index never looks at the quality of businesses that are coming in. If you can choose the right businesses, right quality of businesses, you create good long-term wealth. And there's a very strong correlation between companies' cash flows, return on capital that it generates, and its stock price. So we brought that into the for our investors. So this is what I had to present today in terms of understanding the market behavior through very unique behavioral theories rather than putting a fundamental number to it. And the effort at Bajaj Finserv AMC is to use these studies to create the right products and right returns for our investors. Thank you so much.